Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, November 1st, 2021. I'm going to go through the charts in this order. A relatively brief update on the equity markets, primarily still focusing on the Nasdaq 100 and Russell 2000 small caps, so I'll hit those two, followed by updates on natural gas, sugar, crude oil, the euro, silver, gold, cocoa, which I laid out today as a new trade idea, and then Treasury bonds, do an update there. And it's a lot of stuff, but it won't be very long. I'll just kind of brief updates on each one. All right, this is QQQ, and if you recall, we had all the market-leading FANG stocks report last week, and so as such, you got the volatility, and like I said, you broke down below the 60-minute trend line, but it was questionable, as I said. You get a whipsaw, it was a gap down or opening move down, and they reversed it right away. So really nothing has changed. Like I said, you have to take those breakdowns or that breakdown with a grain of salt. And so far, what we've done is managed to just back test right there. So no real technical change. Again, I'm not going to call that a false breakdown. It was a dip below the trend line, but still questionable. So right now we have the same technical posture. We have negative divergence, and if you want to call it a breakdown, and take it on face value, then call it a breakdown and a back test. So again, I think there's better fish to fry right now. Become a little more interested if we can get a impulsive reversal off there, and then take out the next support level below about 378.44. But again, the technical posture has not changed, so therefore I remain near-term bearish, looking for a correction on or around from these levels here. Next up, let's look at the futures. And then we'll start with NQ and then look at the small cap futures. NQ, 60-minute chart. Same thing. When you look at this 60-minute chart, there was our primary uptrend line that gave us this rising wedge pattern here. You had divergence heading into the FANG earnings right there. And then the last of them to report last week, I think, was Apple and Amazon. Little whipsaw signal there. Quick move back up, and again, the divergence has only gotten larger now, so it's not been taken out. Could get taken out, but I don't think it will. And again, you're going to need to see a breakdown. Now that the FANGs and that post-earnings volatility is out of the way, the next breakdown should be the real deal. And what you want to see is a solid 60-minute close below there, especially on impulsive volume, impulsive selling, additional spike in volume, and that would be your first target and big support there, about 15,536. If taken out, that should open the door for a move down to this trend line down here, the secondary or lower trend line right there. All right, that's what the Nasdaq 100 looks like. So let's wait and see what happens. Still, it's Monday. We're still in wait and see mode from the FANG earnings. Really not going up much, not going down. We're flat. That's, by the way, 0.13% on the futures, and whatever I had there on QQQ, 0.13 as well on QQQ. Alrighty, next up would be the small caps. That's RTY, Russell 2000. So we had a sell signal back here on the break of this bearish rising wedge. Break back test, another objective short, went down, hit my first target to the button, 22.48, and reverse. Pretty impulsive reversal so far. But at this point in time, it's only extended the divergence. Fact, what I can do is just take that same trend line that we broke down below and back tested, and it's another back test of that. So if you look at it this way, there it is. Breakdown, back test, right around those old highs right there, and that should be major resistance. We're a hair above it, but not comfortably above it. This could be a momentum fueled overshoot, and I believe it will be. And so I'm sitting tight right now on the small cap shorts. I think this will fail, come back down, and then remember, we hit the first target 22.48. The trend line would have come in close together had we gone down, and it still could. That's still the next target. But look, when we come down now at this point, those lines are going to come in together. Again, this uptrend line right here in 22.48. So that's my primary scenario. Anything much more than that, and if the Nasdaq 100 continues higher, burns through the divergences, let's just scale out of those shorts and wait for the next objective setup or next objective short entry, such as a break back down below 23.41. But as of now, like I said, the divergences are still in place and still may and likely will play out. And of course, a lot of my focus has been on trading commodities lately. Each one I'll try to mention if you're new to the site or catching up, the various ETFs or ETNs. Usually it's going to be an ETN, sometimes an ETF. Almost same difference, just a little bit different on the taxation and the way they kick out the forms, tax K1s at the end of the year for the ETNs. But SGG or CANE for Kane would be your ETNs, either one. And these are the futures. SB, my preferred trading proxy. Primary trend line was hit. That was mentioned as a long here recently, and also based on this PPO crossover. And then just late last week, I said, it's these high-level bearish PPO crossovers are usually when you get your corrections, and pretty simple stuff, right? So you sidestep that, give back. If you want to recycle in, I would wait for the trend line. Right now we're in no man's land, so I don't really have a play. I just want to follow up and say that was an objective level. So we gamed almost all of that bounce right there, sidestepped it, just based on simple looking at pretty clear patterns on the PPO down here, if nothing else. But of course, PPO. Whether it's divergence or a bullish crossover, things like that, I like to also line up with pull if I'm going to go long on a pullback to support or a breakout above resistance. In this case, it was a pullback to support. All right, moving on to the next one, CL Crude Futures. Still watching this trend line. Look at that. Another pullback to the trend line. Recently, we've had numerous hits of this trend line to help validate it, including these recent hits. The divergences are still intact, so just like the market, no change in the technical posture right now. Still awaiting a solid and impulsive break below the trend line, and especially that 80.75 support just below to open the door for the next correction in crude oil. Next up, the euro via E7. By the way, if you don't trade futures, once again, FXE is your ETN or ETF. I believe it's an ETN as well that trades is long the euro. I usually cover the euro and the US dollar to help confirm my analysis on gold and silver, and in some cases also a pure play trade. And I mentioned that last week. I happen to like that even better. I really like the euro here at that pullback to that 115.45 support. That's where we had come down here, had a few successful tests of that level, put in a divergent low, had the breakout, put us on a buy signal. And recently, nothing goes up forever. We put in that divergence on the RSI, had a impulsive drop, and as I said, it would have been extremely unusual to see the euro continue to fall, not at least bounce. So there it is. There's a minimum target hit. If you took it last week, 115.98, we call that 116, is the first support level, first target. You can either book profits here or look at the bigger picture and say, well, we have the divergence there on the RSI, equal lows so far holding that support, and just let it ride up to you. That would be, again, the next target for a swing trader, even trend trader in this one. Or you took the quick buck and put a, I don't know, probably $500 per contract in your pocket, at least or more than that from taking it there on Friday, and book profits and wait for the next objective entry. Resistance is resistance until unless taken out. So that's how it should play out. And of course, break much below that. If we come back down, it's going to be pretty bearish. It'll take out that divergence. We don't have the divergence there on the PPO. And again, if you are long or bullish gold and silver, ideally you want to see this because the euro is positively correlated to gold, meaning they tend to both go up and down together. All right, now speaking of that, let's roll into gold and silver, GC. All right, there was that breakdown last week. As I said, very well watched level. Again, if you're, use charts and you're watching gold futures, one reason I'd use these futures a lot, among others, is you're seeing round-the-clock trading here, on gold, and you're not seeing that by looking at the symbol GLD. You're seeing 9:30 to 4 p.m. trades, and gold obviously traded around the world. So that's kind of give you a better idea of what's going on there. Anyways, we broke down. Like I said, it was very impulsive, and on face value, I could certainly see why a lot of traders, longs would stop out and shorts might jump in. But so far, it's a breakdown and backtest. I'm not going to call it that rut row moment. When I say rut row, I'm talking about those that shorted it. I talked about the potential for a bear trap scenario last week on Friday with that breakdown, meaning a false breakdown. But for that to happen, we're going to need to recover that level and especially pop those recent highs. Remember, we've been flirting with and tagging that 1809, 1810-ish resistance for a while last week. We had negative divergence when we did it, so a pullback off that level is not to be, should be expected, or at least not a big surprise. The big surprise will come if we can power on through there, and then again that proves to be a whipsaw. Bear trap shorts will start covering, and that's just going to be very bullish if gold can just shrug off those divergences and only have this little minor correction before running up to my next target there. So I'm still favoring that, but again, it is anybody's game. You want to sit here and talk completely objective? Well, you had a breakdown. There's a sell signal on the 60-minute chart last week. You could have shorted, and you could also short here on the back test. Not what I'm doing, but again, hey, I'm going to be right or wrong. I'm just sharing what I see, and you decide what you want to do if you're trading gold. Next up, silver, SI, again, longer term or intermediate term bullish, big divergent low back here, bullish falling wedge, breakout, been walking up, moving up this uptrend line. Recently broke down just like gold on Friday, as well as that $24 level. But look, we've recovered the $24 support, or we're basically on it. I'm not going to say we've recovered it yet, but so far, the buyers, the sellers at least, aren't following up to that recent drop. Remember, we got pretty overbought near term. That's been a nice run up in silver. We caught the bulk of that leg up, hit that 24,867 target to the button, and that's why I have these multiple levels. Each level is where the odds are likely, elevated, well over, over 50%, that you're going to have a reaction on the initial tag. And so if we go up here, hit my 25,849 level. Doesn't guarantee it, but probably could pull back off there, and if we do pull back to that support, that's how I see it happening. And sometimes we'll consolidate a little longer, pull back to the next support, but right now I'm still intermediate and even longer term bullish on silver. But we'll watch it. Again, we start going down, start taking out these support levels. If the euro doesn't play out as I expect, gold, then we may need to, or at least I may need to pull the plug on these precious metal trades. But as of now, still like them. All right, next up, look at cocoa. I laid that one out today for you as a new trade idea. Love these commodities, in, out, hit and run. It's been a strong trend here. Let me actually loop back to that NIB chart real quick for you. NIB is a cocoa ETF, or ETN to be more precise, and for a long time now, been highlighting this trend line, and every single pullback to it since early on in here. I forget where it was back here. Bullish on this one, bullish on commodities in general, and you can see it's just done a great job. It is our primary uptrend line right now. And so I made a comment, and again, it was pointed out right here, it was pointed out right there, and we had positive divergence there as well. Made a comment, somebody commented on Friday's post, that look, if we don't hold this level, I'm going to zoom in a little tighter and go back here. So this is the line I showed you in the video here. It was resistance back here, resistance again, resistance once broken becomes support. Now we have traded through it a few times, I will say that, but for the most part you've had reactions around that level, and it's acted as support for a while there. Few kind of I don't want to call them whipsaws. They were moves down there, so it's not the cleanest, best defined level, but again, you can see when we broke a couple times, we regained it, and finally once we gave it up and couldn't, we took a move down back to revisit that primary uptrend line. So what I said in the comment on a Friday's post is, look, I can't make a screaming bullish case to go long here, but I can make a pretty good case, and so I did. We did come off this divergent high recently. We had a correction, but cocoa, like most commodities, and maybe not as much as all of them, you can see the bull market in cocoa is not as strong. When you look here, there's this big, on the weekly chart, this big symmetrical triangle. Now that's going to be real bullish if and when that breaks out in that 35-ish resistance right there. As of now, again, this, of all the commodities I'm following, this one probably has one of the well, less bullish charts. In other words, you can still say, wow, it's in a primary downtrend line. All the others have taken out their previous reaction lows, energy, most of the other ag commodities, and a lot of the metals, and so they are clearly in bull trends. Whereas this one, the case can be either made. Now, look, it's in a bullish trend since 2017. At least it's making higher lows all along, and you have that uptrend line. So I just wanted to kind of point out that bigger picture and just say, look, if it, like anything else, either pans out or not, we're in a bull market. Just about all commodities are in either bull markets or very strong bull markets. Therefore, the MO in a bull trend is buy pullbacks to support. You can short rallies into resistance as well, especially if you have negative divergence. You can see all the arrows. I'm showing you the divergence. And we got the pullbacks. It's simple stuff. And that's what happened there. All right, so the bottom line is that's it. I can make a decent case, especially based on the primary trend and wheat and other things moving too, that will probably bounce here, and those are your intermediate. And every level I listed here, about 3150-ish, 3290, 3370 are potential targets, and stop somewhat below. Now, what I was saying is if we can't hold that level and we break it by a good amount, then we'll come back down, and I'll be talking about cocoa. And if I forget, I'll throw it out to you. Remind me if it gets down to that trend line again, whether it's anytime soon or months from now. I'll certainly be looking as a potential long entry there, especially if the charts confirm. Like I said, all the better when you have positive divergences and you come to that trend line. There's the last 2 times, and you can see what happened. It was a great trade both times, and so that's it. But finally, I'll move away from this. It's been a while. We just checked the trend line fairly recently, right here. And if you look at the spacing, previously we hit it there, then back here. So by that account, it might be months or a year or more before we come and visit the trend line again. You can see again the spacing here. That looks about 9 months. That's well over a year, almost a year and a half. That's close to a year right there. I'm talking the spacing between when we visited the trend line. So that's why I'm okay stepping in long here. Hope that makes sense for you. And next one up would be go back to the futures, and that was a daily chart of the ETN, and this is a hourly chart, 60-minute candles of the futures. Really good support here, about 2,500 or so right there. You can see it was resistance. We pulled back here, hit support with positive divergence, rallied. Hit it again here, rallied, and we hit it again here, and we have positive divergence in place. We had positive divergence right here when we broke above this little wedge. And this is it. So you can see why I'm more, and for months now, have been in hit and run / swing trading mode with these commodities, because they're, for the most part, especially with cocoa, correcting or moving around in a sideways trading range. And the thing about cocoa and wheat and corn and even crude oil, they don't pay dividends. So if you're going to get stuck in even if you're bullish and you're in a multi-month or even multi-year sideways range, you're not going to get paid. You're going to go up, you're going to go back down, you're going to be, a year from now back where you started. Or you can swing trade. Look for these divergent highs, divergent lows, rallies into resistance, pullbacks into support, and just trade around. If you're trading futures, it doesn't take very many percentage points move in these commodities to make some nice scratch. So there it is. T1, probably get a reaction. T2 and T3. And on this one, I may take profits at T1 if it gets there soon. We'll see. Well, I'll try to continue to do updates. Alrighty, next one, last but not least, Treasury bonds. Told you I'd go through these quick. I still like the 5-year. I have a sweet spot for the 5-year right now. I'll tell you why. This is ZF, 5-year Treasury bond futures. Positive divergence here on, this is a 2-hour chart I'm going to show you. I showed you before the 60-minute chart. I can see the possibility of one more thrust down, and I'd actually put about equal odds on it right now. So I've got a, what you can call it a half position. If we come on down there, I'll probably add up, double up on my position. So I'm long right now, but again, I can see probably equal odds. And the reason I have a position, it may not get there. It may just take off and go up and hit these targets. That's 60 minute. That's 122, 147, 122, 245. And then I showed you before the 3-month chart right here. And again, you can see, we had this right here most recently, actually, the divergence lines. Let me just show you. Here's our divergence, positive divergence. So it really starts from this point. And again, this line could look like this if we want to go down and put in a marginal new low. But the big thing here, and those are your targets, by the way. The big thing is looking at the futures. You go to, I'm not sorry, not the futures, the rates themselves, and that's FVX-X if you're using the TC2000 charting platform. This is the 5-year Treasury yield, and we have some pretty good resistance right here. Let me zoom in a little for you, and you can see that better. There's resistance right there at about 1297.13, which would be 1.3% yield on the 5-year, and that seems to be, it was a big level here. It was support. They kept coming in, buying it there. Finally, when that level cracked, yes, that was the Fed coming in with a nuclear option, taking rates down to the floor. That's why you had that. But again, it's a technically significant level. And when you zoom in real tight, we didn't exactly kiss it yet, but we're close enough. So, when I feel pretty confident that you're going to get a reversal on a trade, I'd rather start stepping in a little bit early just in case everyone else sees that and they start buying the 5-year. Remember, this is the yield. So when the yield goes down, when this chart goes down, the bond itself goes up. Those futures I just showed you go up. And as I mentioned, I don't think there's an ETF out there that trades or holds only the 5-year. They have short-term treasuries. They have the 7 to 10 year, which is IEF. And again, I just have a better read on this one than those. And oh yeah, I wanted to talk about that. One more thing fundamentally. Okay, so there it is. Also, big negative divergence. That's a big thing too. Right here, big positive divergence. See how bullish that was? See that strong divergence there? And it led to this trend. We've come full circle. So I'm looking at this as a potential trend trade. We're going to come down, probably hit this trend line, bounce, work our way down to 920, probably bounce, so I might be able to micromanage this trade. Not that, let's just say right now 920 on the again, the yield 9.2% would be my near-term target, or probably the final target at this time, because I remain longer term bearish on treasuries. But let me talk about that real quick. All right, so recently I've thrown out a few trades, all longs on ZB, and actually even pointed out where you might want to get out, take profits. But we've had these divergent lows, been trading the 30-year, and it's been profitable. You get more bang for your buck because there's more duration in the longer bonds, meaning they're more interest rate sensitive than the shorter term 5-year. But that's where we're at. And you can see that we've already had a pretty good spike up off the recent lows in the 30-year, right? That's again the 30-year bond futures. And go back to ZF, we haven't had that. Now, what I suspect will happen fundamentally, we all know the writing's on the wall. Powell, he's going to start eating crow sooner or later. He's already been backpedaling with this ridiculous inflation pressures are just transitory thing. He's been saying that a little too long, and the numbers are continuing to run very hot, a lot hotter than the CPI is actually reporting. If you know that, if you're into any kind of industry, buying things, you're into construction, home building, food, labor, your cost, you name it, anything in this housing market, you name it, everything's going up, and it's going up a lot. So we know that inflation this is not a transitory thing, and I can tell you, from my experience and my studies, that we've already seen so many price increases. We're not going to go back down to where we were. Nothing else. We've been ratcheting up. The consumers accepted this is the new norm. Sure, things might cool off, and now where I'm going with all this is, it's not a matter of if, it's a matter of when and how much the Fed is going to hike short-term rates. They've already started tapering off on the bond purchases. We know rate hikes are coming, and again, it's just a matter of if and how much, and how much. And so where I'm going with this is, okay, the Fed's going to hike it. Let's say they really say, oh man, we've screwed up. Inflation's really running hot, stock market's hot, we got to cool things down, and they take rates up more than expected, beyond the dot plot. Dot plot is, where people, where the consensus, where they expect the rate hikes to come and at what rate. All right, so let's just say we see a little bit hotter, a little bit more hawkish Fed than expected. What's that going to do? It's going to run up short-term rates, right? More so than long-term, and it's going to help cool long-term rates down, because if the Fed gets more aggressive than currently anticipated on raising rates, what the market's going to take that to mean is it's going to cool down economic growth, and that has a bigger impact on the long-term rates, the long end of the yield curve. The 30-year bond should fall. As those rates, I'm sorry, the 30-year bond could actually rally as those rates come down. But with that being said, it's all about relative performance. I think the 5-year is going to be the bigger beneficiary of an increased expectation in Fed fund hikes. Because remember, the federal fund rate is shorter than the 5-year. The Fed doesn't, it's not the 30-year bond they raise and set the rates on. They don't set the rate on the 5-year bond. They set the rate on the federal funds rate, which is pretty much an overnight lending rate. It's the shortest term rate there is, to the banks, and therefore that tends to have an effect. So anyways, that's where I was going with that, is if the short-term rates come up, that should come up more than expected. That should help increase yields, give you some relative outperformance on the 5-year bond. At least that's what I'm looking at fundamentally. Most important, again, take all that away. Maybe I'm wrong on all that. The charts to me are more clear with that resistance I showed you on the 5-year yield and these bullish divergences here when compared to the the 30-year, which we've already hit a couple times recently. We hit those spikes, but we've rallied up into resistance right now. It's not to say that 30-year can't go up, but look at this. We have negative divergence on ZB right now instead of positive divergence like we have on the 5-year. So this is what I see. You can even do a pairs trade, short the long bond, short the 30-year, and long the 5-year. I think that might pan out as well. Okay, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.